Hello, everybody, and welcome back to video number 3 in chapter 4. And when we left off, we were illustrating how we would present intangible assets. And here is how that would be done. We have our goodwill, patents, and franchises for this particular company. All of those are intangible. And you can see we simply add them together, and away we go. Um, so, in practice, some items can vary. We have long-term prepaid expenses. We have prepaid pension costs, non-current receivables, assets in special funds, deferred income taxes, property held for sale, and restricted cash or securities. So liabilities, we can classify those as either current or long-term. And in the case of current liabilities, we expect that we're going to pay for those within a year or the operating period, whichever is smaller. Okay, so these current liabilities, the first one, of course, is payables, accounts payable, wages payable, taxes payable, etc., anything payable, just about. And that's from acquiring goods or paying for services. These collections are received in advance, such as unearned rent revenue or unearned subscriptions revenue or anything like that that's paid in advance. That's unearned and it is a liability. Even though revenue is in the description, it is a liability. And then we have other liabilities, such as the portion of long-term bonds to be paid in the current period, or the short-term obligations arising from the purchase of perhaps equipment. Okay, so let's take a look at Starbucks here and how they present their current liabilities. And they've got accounts payable, accrued liabilities, accrued payroll and benefits, income taxes payable, a stored value card liability, and the current portion of those deferred or unearned revenues here, and the current portion of long-term debt. So our total current liabilities, quite a few classifications there for Starbucks. All right, let's take a look at the Adams Company in December 31st, 2025 here. And they have accounts payable, pension liability, discount on bonds payable, unearned rent revenue, bonds payable, salaries and wages payable, interest payable, and income taxes payable. Now, not all of these are current, so let's look at those that are. Here, accounts payable, unearned rent revenue, rent that's been paid in advance, salaries and wages payable, interest payable, income taxes payable. You can see that pension liability, for example, discount on bonds payable, and I think that's all that I see that are not current. All right. Long-term liabilities. Now, these are liabilities we do not expect to pay within the operating cycle, or a year, whichever is the greater. The companies classify long-term liabilities that mature within the current operating cycle as current liabilities if the payment of the obligation requires the use of current assets, such as cash. Okay. Coming back to this point, when I first started in business, I was surprised to see the same loan presented in two different places on the balance sheet. They're showing the current portion of that loan and the long-term portion of the loan. I had thought mistakenly so that they had inadvertently put that loan in two different places as a glitch. However, it was properly done. Okay, long-term liabilities. We have obligations arising from specific financing situations, such as the issuance of bonds, long-term lease obligations, and long-term notes payable. And then we have obligations requiring from ordinary operations, such as pension obligations, or maybe even deferred income tax liabilities. And then we have obligations that depend on the occurrence or non-occurrence or one or more future events. We call those contingencies. And sometimes we have product warranties, sometimes we have service warranties. Those kinds of things are sometimes legal contingencies, and those are shown in that way as well. So let's see how that looks. Here's our balance sheet. Here's our total current liabilities. Here's our long-term debt. Benefit obligations, maybe something like vacation and other kinds of things like that. Deferred income tax, non-current operating lease liabilities, and other liabilities. Gives us a total long-term liabilities here. So where do we get this long-term debt? We have several of them shown here, and the appropriate interest rates. And here's Verizon. By far the most of our outstanding long-term debt obligations. And we have some other smaller ones. But we also have some unamortized discount that's a subtraction here, and that unamortized debt issuance costs. So our total long-term debt, including the current maturities, and then less the long-term debt maturing within 1 year. So our total long-term debt would be $100,712, the same as shown here. Okay, let's look at our Adams company, which we did in the past, and here are our accounts payable, pension liabilities, discount on bonds payable, unearned rent revenue, bonds payable, salaries and wages payable, interest payable, and income taxes payable. Now we want to look at the long-term section. And here it's considerably less. We have our pension liabilities, we have our bonds payable, and the discount on bonds payable. As you'll remember, here's that discount on bonds payable. And our total then is $746,000. Okay, let's look at the elements of owner's equity. We have capital stock, additional paid-in capital, retained earnings. Those are the basic components of owner's equity. But here we also occasionally would have accumulated other comprehensive income. And here, that's going to be the aggregate amount of other comprehensive income items, such as unrealized gains and losses on certain investments. And then treasury stock. That's when we repurchase or purchase back our stock from the public. But in the case of retained earnings, we may have a couple of things here. Unappropriated, that's the amount that's available for dividend distribution. We can look at it that way. But if we have restrictions, such as may be on our loan agreements or our bond indentures, that is not available for dividend distribution. It's restricted. Okay, so here, General Mills, they've got their common stock, they've got additional paid-in capital, retained earnings, treasury stock as a reduction, and accumulated other comprehensive loss as a reduction. Okay. So now we'll take a look at Hawthorne Corporation's adjusted trial balance. Again, at December 31st, 2025, we have retained earnings, common stock, bonds payable, paid-in capital in excess of par for common stock, goodwill, and accumulated other comprehensive loss. So how would we show that? Here, we're going to have our common stock, paid-in capital in excess of par, and that totals $950,000, retained earnings, and accumulated other comprehensive income as a reduction to get to stockholders' equity here of $920,000. So I think that's a misprint. That should have said loss, other comprehensive loss of $150,000. But you'll notice goodwill isn't in there, bonds, and I guess that's all that's not in there that I see quickly. Okay. All right. Classified balance sheet in report form, as they call it here. The most common form of the balance sheet is report form, which lists the balance sheet sections one above the other. Very infrequently, companies use other balance sheet formats. For example, companies might deduct current liabilities from current assets to get to working capital. A key definition, by the way, working capital. You can't do much in the world of business if you don't have working capital. So if you're paying all your current assets off with your current liabilities, that doesn't leave you anything to grow your business and prosper. So they might deduct all liabilities from assets to get to net assets, just to make that clear too. So here is what they've done. Report format. I've got current assets. Here they all are. Long-term investments, property, plant, and equipment, and intangible assets, totaling our total assets here. And then here's our liabilities and stockholders' equity, current liabilities, long-term debt, stockholders' equity, and normally we will put a subtotal under equity here so that liabilities and stockholders' equity are summed to total liabilities and stockholders' equity. And you can see easily here that the total assets down here equals total liabilities and stockholders' equity. Okay. And here is a quick version of the Sanchez Company. And it's got common stock, got a lot of different accounts here. And so you want to put that in proper form. And we're going to pretty much mimic the form that you saw in the previous slide. And away we go with our assets and our liabilities. That looks like a good place for us to stop this video. And when we return, we will look at explaining the purpose, content, and preparation of the statement of cash flows. Until then, bye for now.